Hey guys, my name is Ruben Nuts, and in this video we're going to go over the silver trade and kind of what silver has done today. And this has been kind of something that I've talked to you guys about the last couple of weeks, which is the out of the money calls in the specific market conditions. And so here we can see that silver calls, and I'm going to expand on these. We bought them at around $191 or so. So I'm very, very conservative, including, considered my account size. And so that is now worth about $1,800 or so, so a little bit under a 10 to 1 during this point. And I just want to show you guys the entry and the exit because we're going to go ahead and analyze. So what that loads, I want to show you guys the logic between buying silver and why I bought silver uh, versus buying golds, right? So first we're going to go back, and so something that I said before, because of the current market conditions, the reason I like out of the money calls is because if the markets were to completely free fall, the most you can lose is how much you invested in those out of the money calls or at the money calls. And so the risk reward tends to be exponentially higher for those calls because you don't lose all of that fat that the intrinsic or the extrinsic cost can be of an in the money call, especially during these market conditions if it does turn against you. So with that said, I want it to be properly hedged in my portfolio because I am tech side heavy. I am bullish in the market generally speaking because of the 1st and 15th of the month and the way they're designed and so on and so forth. But I wanted to be invested in a different market, and obviously a lot of us talk about gold and silver. So as I was looking at buying out of the money calls between gold and silver, the first thing we wanted to see is how they perform given such market conditions, and considering the fact that I'm buying out of the money calls because of the exponential risk reward. So here we can see that the gain from 1970 low to that 1980 high, gold did a 2,300% return, while silver did 3,100. The fall from 1980 to the high to the low of 1985, we can see that gold had a pullback of 66%. Meanwhile, silver had a pullback of 89%, going over a little bit more, 20% more did silver fall than gold. And then the gain from '08 low to the 2011 high, gold did 166%. Meanwhile, silver did 448%, and then fall from 2011 to 16. The high to the low, gold lost 44%, and then silver lost 71%. So again, we can see that silver is clearly a lot more volatile, but because I was doing out of the money calls in this particular scenario, it is something that I didn't mind going with silver. Not only were the options priced better, I was getting a better risk reward in case of a breakout, which was very, very likely considering the market conditions. So as I said, we do have a little bit of almost a 10 to 1 here in this particular trade. And I want to show you guys the entry and the exit for this trade because I know it has been less than a month, but I want to be exact. And hopefully this Interactive Brokers quote panel does load. But as you can see here, the average price for 5 times 38 cents. So, it was $191 is around is what I paid for right now, being valued at $1,651. And so then we're going to go as to why I bought this particular strike price and why going off of just supply and demand break evens for options is so much more beneficial, risk reward conducive, and all in all just much more simple to understand. And if you think about a lot of the Greeks and deltas and all of that, a lot of those rules don't really matter and they're kind of irrelevant. First, I don't know where the zero point 0.3 delta really came from. It makes really no sense to me. But if we're looking at just this, right? So we're gonna go over whenever I bought into this, we were at around $14. So here's the entry, and so then it looks back at the last time price was here, and then I saw what the move was from the low. So and what such a move could look like during this time. So drawing my supply and demand, and this is the daily time frame, and then I pretty much did a percentage move. So let me remove these drawings to show you guys. So I went from the demand to supply. What percentage was that? 34%. And then realistically speaking, what is the possibility of that happening within the time frame, which I always go at least 90 days of that happening with silver. And so then we saw that, in case of a breakout, this was very, very likely to play out. And the market conditions were all very conducive for something like this happening. So going now back to present time, we can kind of see that it did exactly what we thought it was going to do. And so with that said, here we are, not surprisingly. So now we're going to look at current price, and then it's very clear to see why the logic was what it was, going off of supply and demand levels. Now, I always tell you guys that I usually don't cash out at supply because the markets tend to continue to go up. Because this is a commodity, I will likely cash this out because commodities are not designed to go up in the same way that um, uh, equities are, right? So here we can also consider a split, right? Could this be the new low to catapult to $34? So then at this point, there's an additional $10 reward here, which would equate to $5,000 with 5 option contracts. So I'll probably take 2/3 out and then leave on the rest running. And so I hope this video was helpful, guys. And let me know in the comments, or if I will expand on this for the OTA alumni. And like I said, we are going to do a lot more option stuff. So anyways, love you guys, and I will see you guys next time.